basically kind of just discussed kind of this, but more of like a PowerPoint presentation. Just wanted to go over some things I thought would be important if you're invested or looking for a good like dividend company. So yeah, let's get into that. So just to be fully disclosed, I am invested in 3M. That's kind of why I am looking at all this stuff. However, again, I'm looking to find things I dislike as well as like about the company and how their management team is doing, or how they're managing this crisis, kind of, you know. Anyway, the third quarter highlights: sales of 8.4 billion, up 4.5% year on year. Organic local currency sales, so their estimated EPS was 2.43. Wall Street had estimated earnings at about 2.27. They actually 2.43, so they did that. Beat earnings much better than expected. You can see right now it's like 10:30. You can see they sold off in the morning, but now they're kind of rebounding a little bit. Their operating cash flow of 2.5 billion was up 23% year on year. Adjusted free cash flow of 2.2 billion, up 13%. They're strengthened their capital structure, reduced debt by 1.2 billion, down 6%, and net debt by 1.3 billion, or 8%. And they mentioned also here, they mentioned there each month they're going to continually add a monthly sales report just to show progress of the company. They did not offer forward guidance because of uncertainty. However, that's kind of understandable, but they did kind of give fourth quarter expectations. Their next quarter they're going to report January something, I think later January. Yeah, anyway, so total sales grew 25.5% year on year in healthcare, 6.9% safety industry, and 5.6% in consumer, with a decline 7.4% transportation electronics, organic local blah. Doesn't really matter too much. They have a better chart that explains this. Maybe I'll pull that up. Yeah, these are the slides. They have a little bit more, aesthetic appeal to them. So they're up 4.5% in net sales to 8.54 billion. Their operating income was basically on track to last, I think this year, to nearly, yeah. And their net income was down, they mentioned, because they had lower operating margins, or they lower margins on their products. So that's the reason why they are a little bit down. The earnings per share, yeah, actually my bad, it is down about 5% from last year, but that's not that bad in my opinion relative to what happened, this past year. Cash flow is about 2.2 billion, marketable securities and cash 4.6 billion, and paying about 8 billion in dividends. So yeah, year to date 2.5 billion in cash flow, cash dividends. Right now their dividend is 3.54%. I think it's about 3.5%. I think that's a pretty good starting yield on this company. Now here's what I mentioned back here. It's just a better way of looking at it. Safety industry, they were up a little bit. Down transportation and electronics kind of makes sense. The healthcare saw the large increase, which also makes sense. And consumers also had a big increase. So overall, they are increasing their sales or organic growth, but also, wait, real quick, their margins are like 25% on average. That's pretty good margins. It's relatively to this company, they are on track. It didn't really change too much with their margins. However, it is good margins in my opinion. Sales increased in personal safety, roofing, granules, automotive aftermarket. Sales declined in electrical markets, industrial adhesives and tapes, closure and masking systems, and abrasives. I guess I'm kind of increased in the roofing. I know home improvement has had kind of an increase, which is a little bit of a shock in my opinion. But I guess it is following the thesis of other companies like Home Depot are doing. The automotive aftermarket, I guess that means more used products and fixing or repair. That makes sense, kind of. More people are gonna do that as to purchasing a new car. Transportation electronics, their sales increased in electronics, decline in transportation and safety, consumer solutions, automotive, aerospace. All that makes sense through electronics. I'm not exactly health for. Like again, companies are gonna look for medical solutions and a way to, purify their either office space if customers are going into work or employees. This just makes sense. I think their main, yes, my bad, okay. Their healthcare, all this is kind of geared towards the, like B2B, and this is just their consumer brands, Scotch tape, there are other consumer adhesives, but also in their consumer brand, their sales grew in home care and home improvement were flat in customer health and decline in stationary office supplies. I mean, yeah, office supplies make sense. People are buying stuff for their home and stuff, but at the same time, they don't need as much as, say, going into work, home improvement grew again, that kind of supporting this over here, roof grew, whatever, home care. So, I mean, they had some parts of their business decline and fall because of, it's just how it works, because of the pandemic. At the same time, this is a good company in my opinion because they're not reliant too much on one product or one sector. They have, again, kind of 4 sectors within all the products they sell, so they have a wide variety of potential customers that need different things. I think that's important. So 3M is not able to estimate full duration, magnitude, and pace of recovery across its diverse end markets with reasonable accuracy. So they're basically not providing guidance. That kind of makes sense. It's alright, but no, we'll just have to, stay updated. But we can get into their actual balance sheet and stuff. This is their income statement. So I mean, I like to look more at the longer time frames as opposed to what happened last quarter. So 9 months ended this September as opposed, September 30th as last September. They're kind of about the same. They are, I mean, that's not terrible as opposed to the 9 months back then should be much better than now. They are basically on track. Let's go to operating income. They actually have more operating income as opposed to that. That's interesting. Let's see. Earnings per share. Earnings per share 9 months out from last September 30th. They're actually about 70 cents higher. Interesting. But their quarter end is much worse. Their cash equivalents is up about 2 billion. Wow. From December 31st, 2019, total assets about the same. Liabilities, they actually paid down some debt. They paid down a little bit of long-term debt. Yeah, that's what they mentioned in that thing. That's good. That is interesting too. I'm surprised they decided to pay down their debt, or maybe they refinance stuff too, because of the low rates. But that's something you usually like to see in a company. The total liabilities and equity did increase. One thing they mentioned is they can't do any share buybacks or purchases. I think that's the law right now or something. Not entirely sure about that, but they just said they're not going to do any buybacks because they can't. Cash flow, they're down about half, maybe a little less than half, as to what they were a year ago or 9 months ago, or you know what I mean. This 9 months compared to that 9 months. Let's see. They have more net cash by using operating activities. That's up about $1 billion. Net cash by financing activities. That's a lot different of a number. And that's just because the cash flow from financing activities, this part is not positive, at all. Change in debt. Okay. Let's see what this is. This is the good stuff. Operating income margin. About 23% all around. Income before taxes, Let's see. Effective tax. Wow. Getting taxed a lot. Okay. First 9 months. Operating income. I mean, I think their margins are pretty good, but for the company, it's about consistent of what they've been performing. This stuff, this kind of breaks down exactly, in each sector. Adjusted earnings before income tax and all that stuff. This is a non-GAAP measure, though. That's important to keep in mind. So it's not really what's the word? Like legal, I guess is the word, or reputable. But it's I guess an easier way of understanding their business from their point of view. They actually made this point of view. Their total company made more this 3 months quarter than this 3 months quarter by about a couple hundred million maybe. It's about the same percentage though for the margin. That's cool how they broke this down to just help better. Again, this is non-GAAP measurements, but I think it's not standard because this company or 3M wants to just show this to us. I think that makes sense. They keep going on and on. This is unaudited though, so it's not really super reliable. But I think would be good kind of to read. But man, I'm getting real tired over here. Yeah, I think so. There's nothing about this that I read in the company that kind of makes me concerned. Am I gonna buy more? I'm not sure. I do like the company. I think the yield's fine at a good pace. My thing is, I kind of want to. I'm pretty sure they're gonna announce their dividend really soon. I don't see them cutting it. They have no reason to. Their balance sheet's pretty strong. They're still making good money with the same amount of margins and stuff. So that's good. Yeah, it just seems like they're on pace to doing exactly what they've been doing. So I don't see anything bad about the company really, from what I read. But again, I'm not a financial advisor. I'm just a guy, talking about his opinion. So just keep that in mind. But yeah, let me know what you guys thought. Do you guys like the company? Do you guys think they're doing good? Do you think they're going to be struggling in the future? This is their monthly time frame back from last like 20 years.